All right, so today what we want to talk about is the three financial institutions that are competing for our dollars. And so if you think about money and the world as a game, many times we all know how to play different games like football and basketball and so on. However, when it comes to money, a lot of times people don't know the rules to the game. And so the consumer is oftentimes at a disadvantage. And so what we want to do is just talk about the different companies that are competing for our dollars so you have a better understanding of the way the game is played. So there's basically three institutions. We have banks, insurance companies, and Wall Street. And so just imagine taking your money down to the bank. And oftentimes you'll get different advice from different places that you want to go and park your money. So for instance, if you go to the bank is probably going to recommend that you put your money into such things such as CDs, money markets, savings accounts, and so on. Now, the thing is about the bank, when you go to deposit your money at a bank, the interest rate that you're probably going to receive in today's interest is anywhere from 0 to 2%. So it's not a whole lot of interest. However, that bank would be happy to turn around and let you deposit your money. They'd pay you 0 to 2%. And then if you wanted to borrow money, they might charge you 7 to 8% interest on that money. So the banks really are in the business of making money on loans. And so today, many people are not very attracted to this 0 to 2% interest rate simply because it doesn't even keep up with inflation. However, the money's liquid and you can get to the money whenever you'd like, and so it does serve its purpose. Then there's another institution called insurance companies. Again, insurance companies are in the business of making money off of our money. And so anytime we all have insurance, homeowners insurance, car insurance, life insurance, annuities, all these different products that are issued by life insurance companies are designed where the company takes your premiums and they hope that you don't make a claim. So, you pay for car insurance for 30 years perhaps, maybe never have a car wreck. So that's where the insurance company makes a large percentage of its money. However, in the financial world, when it comes to saving money, generally what insurance companies offer are such things as fixed annuities, indexed annuities, life insurance, cash value life insurance, and so on. And so generally in these particular savings tools at the insurance companies, you could expect to receive anywhere from 0% interest on some of these accounts all the way up to maybe 15%. So as long as they're fixed accounts with insurance companies, the money is deemed to be safe, but the growth potential is limited. Then we have Wall Street. And Wall Street has a unique model of investing money. Again, people maybe are not so happy with the 0 to 2% interest that they can receive at the bank. They may have something against an insurance company perhaps. So Wall Street is always out there, and it's kind of the carrot that you can chase after in order to earn more interest. And so Wall Street has a very unique business model. Basically, they want you to park your money in their organization and they charge you a fee no matter what happens to your dollars. So basically, the types of investments that you can have in Wall Street are such things as stocks, bonds, mutual funds, ETFs, and so on. We could go on and on. And the way that the Wall Street makes their money on these dollars is they say, hey, we want to invest this money on your behalf and we're going to charge you a fee. If the stock market goes up and your money makes money, the brokerage company makes a fee off that money. Here's the fun part for Wall Street. If the stock market decreases and you lose money, guess what happens to Wall Street? They simply make a little bit less money by managing your accounts. So it's a win-win for Wall Street, but maybe not so much for the investor. However, it does serve its purpose. And so in any given year, you may lose up to 30% or more, or you may gain up to 30% or more. So there is growth potential, but there is the possibility of losing your money. So ultimately, you have to, in the money game and having the three financial worlds, it's simply using the tools that you have available to achieve what you're trying to achieve. And that's what we'll talk about in some of the next videos that we'll have.